Hello and welcome to our webcast. I'm Danielle Johns with Moss Adams, and I'm going to get us started for today's session, Fall 2023 Not-for-Profit Accounting and Auditing Update. We're pleased that you've joined us today, and before we begin, I'm going to play our housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
We have a couple great speakers with us today from Moss Adams, Sasha Correnti, partner, and Ashlee Lent, senior manager. Their bios and contact information are located in your webcast console for your convenience. And now I'd like to turn the floor over to Ashlee to get the presentation started.
Hello, everyone. So first, I'm going to start with the agenda here. We're going to have an internal control considerations and kind of focus on best practices here over internal controls. Secondly, we're going to go through the data collection form updates within the new site. Next, go over the new CECL standard. And last, we're going to go through some auditing standards and how those impact your organization. So for your learning objectives, we're going to help you to identify changes to financial reporting and disclosures that could impact your organization. Also, recent hot topics in the industry, this is the data collection form, internal control best practices, and some of those auditing standards that could have an impact on each of your organizations and audits in the near future. Internal control considerations. We're going to start here and go into the first polling question.
Great. So our first polling question for today is, what type of organization are you? A, higher education, B, foundation, C, social welfare or charity, D, other. The polling questions are located right on the slides we are presenting. If you can't see it, you can hit F5 to refresh your console. To respond, please click the button next to the answer you choose and hit Submit. And we'll go ahead and leave this up for just a few more seconds for a few more of you to respond. And here are the results.
That's really interesting. I wonder what all of the others are. We have auditors with us, like other accountants, what type of organization you're with. Let us know. So we're going to jump into shifts impacting internal controls. So the last few years now at this point have been very volatile and creating lots of shifts in the industry. So organizational changes include restructuring, dissolutions, acquisitions. All of these have been increasing and may continue to increase as the market and economy changes. Additional roles and responsibilities within each organization have been changing, and wearing different hats have become more regular. Processes, as a result, have been changing more frequently for many organizations. And you can see the outcome there is just the lack of that consistent process. The Great Resignation has created less resources in many organizations, and the need for succession planning continues to increase, which creates additional demand for strong policies and procedures. This will be described a little bit further in a future slide, so I'm going to leave it short right now. Remote and hybrid work continues to create demand for frequent and strong communication. Some of this is a learned behavior that occurs when working closely with someone or a team of individuals, and it may be happening less in the current environment as many professionals and different people in the industry are utilizing that remote and hybrid work style. Some of those learned procedures and things demonstrated in person might be decreasing. Demonstrating tone at the top has become more challenging in these environments as well, as there's less in-person communication and chances to connect. Leadership changes, as well as those changes to those charged with governance, become more frequent these days, and this is creating less reliable oversight and also a heightened opportunity for fraud within many organizations. So we wanted to go through this because this is what we're seeing in some of our audits currently. And as we're kind of wrapping up a lot of the September and October deadline engagements, we wanted to bring all of this very forefront in your mind for changes going into the future and things to kind of address in this next year. So management is rethinking manual processes and looking for, in many cases, IT software to assist, especially around processes that are in office or as remote work is becoming more regular or a position changes that becomes a hybrid position. This has most likely occurred within your organization, but it may continue to increase over time. System access levels are being changed regularly. As many of you have implemented new softwares and additionally had turnover, there are many things to consider when it comes to user access. This is a result of many things as well. It's not just new employees and changes in roles, it's the new systems, and just really stepping back and ensuring that that user access is being reviewed regularly, which means at least annually, if not more frequent, to make sure that changes are representative within your softwares. As employees have transitioned to remote and hybrid work styles, in many cases, approvals have become more challenging and could be performed via email. This is still a control that's in place, but it can be pretty burdensome to maintain the documentation that way. So trying to implement softwares or processes that make it a little easier for documentation is essential. P-cards are being used more frequently to document controls, streamline processes, and also as a function of the remote work being performed. We have seen supply chain issues. None of this is new information there. This has also created more sole source purchasing, new vendors being added to your systems, and as a result become more of an important control cycle in the current environment, especially with the increase in cybersecurity attacks through phishing schemes. COVID has increased the amount of federal funding to organizations. The increase in the federal funding has created the need to have grant management cycle become a key focus area. When thinking about grant management control cycle, I think of strong financial reporting and a strong understanding of compliance as the most critical functions within that cycle. We have seen the increase in direct funding as well as beneficiaries and subrecipient funding. The difference isn't always very clear, so also maintaining clarification support and performing inquiries is really important these days with federal funding. Lastly, for all of these reasons, strong policies and procedures are really essential within your organization. Internal control reviews. When reviewing your policies and procedures, this really should be done at least annually, but if it's been a few years, really stepping back and taking a look at these cycles. As you can see here, we've listed out some of the more traditional, typical cycles that we're seeing that are very relevant to most of our clients. And then you can see here payroll, purchasing, and accounts payable, monthly account reconciliation and that closing process, cash receipts and cash handling, so that cash management cycle, revenue and billings or AR, accounts receivable and write-offs, grant management and compliance. So these are all typical, very relevant cycles. One that isn't included on here that is very key as well is IT. So ensuring that user access and security is maintained and not too much access has been assigned. And change management over those IT softwares is limited to the appropriate personnel, and testing is performed when significant upgrades are occurring. So after you've read through those policies and procedures, making sure that they're current and represent the controls and processes in place right now, including all of those new IT softwares implemented, is key. Evaluating each for effectiveness individually by significant cycle, and then also stepping back and evaluating for current and planned operations of the organization. Internal control testing is very important. This helps to ensure that the control is operating as designed, and so creating a sample and testing that sample throughout the year will ensure that you have a good understanding that it's being performed regularly and documented well throughout the year. Lastly, identifying and developing recommendations for improvements. Connecting with your team is a really great way to look for areas of improvement. Each team member can be involved in how to improve the process and can be very rewarding as a team to collaborate together. Also, knowing what risks there are to the organization and developing ways to address each of these risks are great ways to stay on top of upcoming changes and changes to internal controls that are necessary. So next, segregation of duties. I know everyone's heard these terms before. Keeping the authorization, custody of assets, recording, record keeping, and reconciliation separate is really the most important item within this. But also taking into consideration, controls don't need to be so challenging that they interfere with your operations and your day-to-day transactions within reason. Trying to safeguard assets, having strong IT controls, having strong review processes, and ensuring that no process can be completed by one person without oversight is essential. Without segregation of duties, you're at risk for the occurrence of fraud, and even with the best intentions, human error can occur without a mitigating control and even go unnoticed or undetected. As auditors, we would rather brainstorm with you about recommendations that could be made around your controls than we would find an error at the end of the year and have to report a control deficiency that resulted in a detected error. Ways to segregate For smaller organizations, including your board can be really helpful. At some organizations, I've seen board members who authorize disbursements as a check signer, even if it's at a more significant threshold. At others, reviewing budget to actual reconciliation is a great way to have oversight and understanding, and also a way to document review over the reconciliations. Involving someone outside of accounting when there is a small team in place, such as a CEO, executive director, or someone else in management of operations, can be really helpful. Departmental budget review, when performed frequently and documented well, can be a really strong control over disbursements and classifications of your expenditures. Authorizations and approvals. So within the policies and procedures, defining the role and responsibility for each of those roles and the authority limits is a strong policy. A couple great examples of this is within the disbursement and borrowing cycle. Who are the key decision makers and at what role? Are there limits or small transactions maybe where this isn't necessary? How involved are your committees and boards? Are you willing to utilize them and use their skill sets to benefit the organization, and how can you assist with that? Understanding the process and expectation of documentation is essential. Who approves and when? Another key item within the policy is who approves is a key item within the policy. Understanding the documentation is evidence and the control of operating in a timely fashion. Having both a preparer and a reviewer initial with dates can solidify that the control is occurring and within the timeline as expected. The documentation is really the evidence that your control is occurring as designed. When something is inspected, unexpected, or outside of the design of the controls, it may be worth questioning and documenting. Is there a reason that it was necessary? Or maybe there wasn't. Documenting the response and, when appropriate, escalating the information obtained through that inquiry to the appropriate person may be necessary. As turnover has impacted almost every organization in one way or another, the value of policies and procedures has increased. Planning for when turnover occurs rather than if it occurs has become imperative. Making policies and procedures that are clear, consistent, supportive, that have defined expectations, and are extremely explicit can assist with this turnover, retirements, and transitions as they occur within your organization. Internal audits. Whether your organization has an internal audit function or this responsibility is really a part of management's oversight role, it is both preventative and detective as a control. First, if there is an increased perception of oversight, the work product and adherence to the policy and procedure increases. This is important to demonstrate as management how important this role is at both preventing and detecting errors when they occur. Second, when oversight is being performed, a better understanding of the control cycle is designed, of how the control cycle is designed and implemented. This also assists you with understanding what threats there are to the control cycle and if there are any gaps. This allows for best recommendations for improvements. Also, scheduling a debrief meeting to follow up with what went well, maybe post-audit, post-close, and really look for improvements that could be made in the future is really essential and can assist you with while everything is fresh, making change to the policies and procedures and looking at what ways can really those improvements benefit the team and the organization. Enterprise risk management. So some larger organizations have a enterprise risk management either as a separate committee or also an identified role within the organization. but unfortunately, small organizations may not have that luxury. The three key elements here are really the risk identification, risk analysis, and risk evaluation. Aligning your strategic goals can help you become more efficient and effective. And also aligning them with your operations will help you to improve your future trajectory. Implementing strong internal controls can go hand in hand with accurate, reliable, and timely, both from a financial and compliance aspect. This will allow management and those charged with governance to make educated decisions, and this information is many times relied on by different users within the organization. So keeping that all in mind. And next, we're going to go into polling question number 2.
Fantastic. For our second polling question, what are types of key internal controls? A, segregation of duties. B, authorizations and approvals. C, safeguard assets. D, all of the above. You do have the option to submit questions for the presenters in the Q&A window. We have quite a bit of content to cover today, so if we don't have time to respond during the webcast, we will do our best to follow up with you afterwards. And we will go ahead and leave this up just for a few more seconds. As a reminder, please respond right there in the slide, choose your answer, and hit that submit button. And the results.
Great. Thank you, Ashlee. What a great update on internal control matters we should all be thinking about and evaluating. We are 3 years past COVID, and it's the perfect opportunity to revisit those policies and procedures. I know especially as it pertains to the ever-changing IT world that we live in, so it's great for us all to bring those thoughts front and center and revisit them. We are now going to shift gears and provide a brief update on what is happening with the new data collection form, website, and process. Hopefully all of you out there receiving federal funds and responsible for submitting a data collection form are aware of the recent change that took effect October 1st of this year related to the new website and form. The provider of the Federal Audit Clearinghouse, or FAC, changed from Census to GSA effective October 1st, 2023. GSA is now the new provider collecting and accumulating the data collection form information. As a result of this change, there is a new website where you will go to input your organization's data collection form information, www.fac.gov. Single audits with a fiscal period ending in 2022 or earlier should have already been submitted to Census FAC. As a result of this change, any draft not fully submitted to the Census FAC previous provider by that October 1st deadline may need to be completely restarted in the new GSA FAC site. Single audits with a fiscal period ending in 2023 will be submitted directly to the new GSA FAC site beginning back on October 1st, 2023. A few general updates related to this change. Search and download of audit data from 2016 to 2022 will remain on the Census's site. This is the previous site through end of this calendar year. This data will then migrate to the new Federal Audit Clearinghouse by the end of the year. Single audit data for fiscal year 2023 was made available mid-October. I know I'll be curious to see how this transition goes of information. I'm hoping it will be smooth, but I do think we've all learned from experience that sometimes these migrations aren't always as smooth as one would like. With the migration to a new system, it's not without its challenges. Direct from the FAC.gov website, it was noted by FAC that we released the GSA FAC as a minimal viable product. That means we are continuing to work and improve the FAC. We work in an agile manner. At the time this presentation was drafted, and in the few weeks that followed migration, there were some initial glitches that were reported. Some of the glitches identified included there seems to be no ability for the completed data collection form to be downloaded or printed for review prior to certification. Only the actual workbooks submitted to GSA for upload were able to be reviewed. In addition, issues were identified with the system recognizing recipient unique entity identifier numbers. According to the GSA, as of October 26, all of these issues have been resolved. Full transparency from my perspective, I have not myself gone in and verified the accuracy of the resolution of these matters. I have connected with colleagues, and some continue to experience issues, and some indicate the situation has resolved. So really, this is more of something to watch and to be aware of as you embark on the process, and to alleviate the sense of alarm when you realize that things aren't functioning in a way different from what you have experienced previously on the old site. I was back on the FAC.gov website this morning, and it disclosed that as of October 27th, they have encountered a new bug. The site discusses, this is not a bug in our software, but in one of our support systems. We are working with our system providers to understand the bug and resolve it. Until it is resolved, we have to slow releases into our production environments. This bug does not impact data quality or the current operation of the FAC. But this is something to be mindful of. So what does all of this mean, and what are the next steps for those trying to get their data collection form submitted? As mentioned, the GSA has worked to address these as well as other issues identified in the near term. If possible, members may want to consider waiting a few weeks before attempting to submit single audits to GSA until some of the early kinks have been worked out. There still seems to be some inconsistencies, and if there's opportunity to wait an extra week or two, that may be recommended. The FAC has a page that will continue to give updates about this site. The webpage link is included on the slide for your reference. My experience has been that they do work to update this site on a routine basis, so feel free to check in regularly if you have concerns or are experiencing any issues yourself. Link to that site is included. They also have a help center, which has some Q&A, which you can find at that second link there. And if you are still looking for additional reading material, the final link on the slide connects you to some other information about the actual data migration process. I really would encourage you to visit these links for good information on current status and plans. I find they are doing their best to update them routinely, and the first site related to the updates not only addresses challenges they have encountered, but also provides information on planned improvements as they continue to improve the functionality and features of the site. All right, shifting gears away from the data collection form, let's catch up a bit on some of the recent accounting standards that will be effective for this upcoming year. Well, spoiler alert for all of you out there, it's been slightly quieter, and it's actually a good thing. So there's only one big thing to talk about this year, and that's CECL. In the recent years, we've made it through implementation of the new not-for-profit reporting standard, revenue recognition standard, the in-kind contribution disclosure standard, and most recently, the really fun one of leases. I do feel like we've talked about leases for over a decade, so it's nice to have that one finally out of the way. So now it's time for us to discuss CECL. But before we can do that, it's time for our next polling question. I'll pass it back to you, Danielle, for a moment so that you can ensure everyone gets their CPE.
Thank you. Here we are with question number 3. How familiar are you with CECL? A, what is CECL? B, I know a little, feel behind the curve. C, I have a solid foundation. D, I've audited a CECL model before. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And remember to select A, B, C, or D on the slide there and hit submit. And we will allow a few more seconds for a couple more responses. And the results.
Wow, interesting. So it does seem like we have some discussion to do on CECL. So hopefully the next 10 minutes of content everyone finds useful and people can understand and define what CECL is and decide what might be applicable to their organization. So I'm glad we have this content for everyone. All right. I realize this has been a really big change in the standards for NFPs this year, and I'm sure you all thought had been previously exposed, but it seems like we do have some learning to do on this. So let's go ahead and get into that. The Financial Accounting Standards Board issued the final current expected credit loss, aka CECL. They really love their acronyms, don't they? Standard in June of 2016. It does feel like a long time ago. The new guidance particularly impacted community financial institutions by modifying or replacing existing impairment models for financial assets, such as trade receivables, loans, debt securities, and purchased credit deteriorated assets. Under the CECL model, a company's estimate of expected losses should represent all contractual cash flows that a company doesn't believe it will collect over the contractual life of the financial asset. This could be up to 30 years for certain types of loans, such as a consumer mortgage. We were in that practice. In practice, estimating credit losses over significant periods of time, as well as applying other aspects of the CECL model, will be challenging. As you look at the graphic down in the right-hand bottom corner of the slide, you'll see that when you now apply this standard, it's factoring in not only historical consideration, but now is a combination of past performance, so historical, future forecasts, what are you now predicting, and impacts of current conditions. So why the change? Users of financial statements were making their own assessments, and there was potential in the past for overstatement of the asset. What is included within the scope of CECL? Financial assets with contractual cash flows known as financing receivable. Financing receivable would be a financing arrangement that has both represents a contractual right to receive money either on demand or on fixed or determinable dates, and 2, is recognized as an asset in the entity's statement of financial position. Some examples of that would be contract assets that are recognized under ASC 606, loans, held-to-maturity debt securities, loan commitments, or other off-balance sheet exposures, your trade receivables, lease interest, reinsurance receivables, and also programmatic loans. Probably of more interest to all of you out there, what's outside the scope of CECL? What do I not have to worry about? Items that will not fall within the scope of the new standard include loans made by participants in 401k plans, pledges or contributions receivable for NFPs, guessing this will be the major one you all are thinking about, loans and receivables between entities that are under common control, derivatives, receivables arising from operating leases under Topic 842, financial assets measured at fair value through a change in net assets. While not applicable for not-for-profits per se, still important enough to warrant, available for sale securities are not within the scope of CECL, but under the securities guidance of ASC 320 was separately amended to eliminate the concept of other than temporary impairment. As amended, an entity must use an allowance approach. Credit cash flow related losses are included in allowance. Other unrealized losses run through other comprehensive income, and limit the allowance to the amount at which the security's fair value is less than the amortized cost. Good thing this likely isn't impacting many of you on this call today, but wanted to call it out that it is part of the standard. To highlight the key changes, the new standard requires a financial asset or group of financial assets measured at amortized cost basis to be presented at the net amount expected to be collected. The allowance for credit losses is a valuation account that is deducted from the amortized cost basis of the financial asset to present the net carrying value at the amount expected to be collected on the financial asset. The statement of activities reflects the measurement of credit losses for newly recognized financial assets, as well as the expected increases or decreases of expected credit losses that have taken place during the period. Lastly, it eliminates the probable initial recognition threshold in current U.S. GAAP and instead reflects the entity's current estimate of all expected credit losses over the full contractual term. In theory, the first three bullets are not all that different from how matters are presented under current U.S. GAAP other than terminology. It's the fourth bullet that really is the key change, and we will talk about that a bit more on the following slide. The slide here provides a visual of the major change in using an incurred loss model to now using an expected loss model. When using the expected loss model, you will consider factors such as principal, lifetime expected losses over the contractual term, management's best estimate at a point in time, specifically requiring management to be forward-looking, and applies to all loans not carried at fair value, along with certain other financial instruments. In developing the CECL standard, the FASB acknowledged that as the forecast horizon increases, the degree of judgment involved in estimating expected credit losses also increases. Under ASC 326, an entity shall not rely solely on past events to estimate expected credit losses. When an entity uses historical loss information, it shall consider the need to adjust historical information to reflect the extent to which management expects current conditions and reasonable and supportable forecasts to differ from the conditions that existed for the period over which historical information was evaluated. The adjustments to historical loss information may be qualitative in nature and should reflect changes related to relevant data, such as changes in unemployment rates, property values, commodity values, delinquency, or other factors that are associated with credit losses on the related financial asset or in the group of those financial assets. To summarize what the guidance in the standard is saying, you can't just use historical information to estimate credit losses. There is a requirement to incorporate an element of forecasting. The historical information may need to be adjusted to reflect depending on current conditions and forecasts. There is no prescribed methodology or required information to use for reasonable and supportable forecasts. The forecasting methodology will really be something the organization needs to determine and also document. So what does all of this mean for not-for-profit entities? First, let's address your standard trade receivables. Under current U.S. GAAP, trade receivables that are either current or not yet due generally do not have a reserve. Going forward under the new CECL model, they will now have an allowance for expected credit losses. Let me be clear with that last comment. There is no requirement that they must have an allowance. However, there is a requirement that the methodology consider whether there is a need for an allowance based on the forecasting methodology process. In general, we don't expect that the majority of not-for-profits will need complicated modeling to develop their forecasts. Discounted cash flow loss estimation methodology generally not expected to be used given the short-term nature of trade receivables and non-credit related adjustments, such as returns and discounts, which should not be considered for CECL purposes. In applying the standard, let's not forget that there is still a concept of materiality in application. If you have immaterial items, the organization can consider a policy whereby the standard is not applied to such items. As always, this comes down to documentation, documentation, documentation. Management should document basis for why CECL does not have a material impact, including consideration of past disclosures. Depending on management's documented policy, the auditor communications will likely address implementation or lack of materiality regarding the standard. In considering application, it may be determined that a pool of assets have never experienced past credit losses, and current information, when adjusted for reasonable and supportable forecasts, indicates the same. It may be then concluded that no credit loss is required. Implementation of CECL requires the use of the modified retrospective approach, which means a cumulative adjustment to the opening net assets will be recorded at the start of the year of adoption for the difference between the previous historical loss allowance and CECL. In the first year of adoption, the 1/1 and 12/31, if you are a calendar year, CECL balances are subject to disclosure. What this means is you will need to ensure your financial statements not only include disclosures for your 12/31/2023 balances, year of adoption, but also as of 1/1/2023, the beginning of your year. So you'll need to determine your CECL reserve as of both dates. There will be ongoing disclosures required, and there are specific disclosures required in the period of adoption, consisting of the nature of the change in accounting principle, including an explanation of the newly adopted accounting principle, method of applying the change, effect of the adoption on any line item in the statement of financial position, if material, and cumulative effect of the change on net assets. Effective dates. Well, we are here. If you have a 12/31 year end, you will be implementing this standard for this upcoming 12/31/2023 year end. If you have a June 30 year end, this standard will become effective for your June 30, 2024 year end. We realize that since the implementation of leases, there hasn't been a ton of new accounting updates to report, and so CECL really has taken center stage in terms of the discussion. We hope that this continued discussion continues to educate and help with your understanding. So what do you do now? Well, you can ready yourself for this new standard by reading the actual ASU 2016-13 and the available white paper. You can decide what methodology will be used to compute CECL, ensure historical data to support computations is readily available, consider sources of internal or external factors to be used to make future projections, develop policies, procedures, and internal controls over those CECL estimates. Okay. With that, I know that was a lot on CECL. I'm going to toss it back over to Ashlee for some auditing standard updates.
Thank you, Sasha. So I'm going to go through some new auditing standards. Each of these that are shown here are Accounting Standard 143, 144, and 145. Each are applicable for audits performed as of with the year ending 12/15/23 or after. So really what that means is for any of the calendar year ends of 12/31/23, this will become effective. I will go into SAS 143, auditing accounting estimates and related disclosures in more detail in a slide to come. We're going to kind of go through a few of them in a little more detail, but really want to focus on the impact of the change in the evaluation of auditing estimates within the financial statements as well as the disclosure notes associated. SAS 144, this amends a few standards, excuse me, relating to the use of specialists. These specialists actually are both on the management side, so any specialists you are utilizing, as well as the specialists used by the auditor. Additional inquiry and documentation surrounding the use of these specialists may be the impact of the standard to your organization, depending on the use of valuation specialists. We'll go into SAS 145, which is understanding the entity and its environment and assessing the risk of material misstatement in more detail in a slide to come as well. But remembering this will be effective for the calendar year end of 2023 and for all of your fiscal year ends in 2024 to follow. This standard changes the way that the auditors really assess risk and will inherently change the way that audits are performed in the future, some more significantly than others, as complexity and other factors play a significant role in this. And next we'll look at auditing standard 146, 147, 148, 149. Really, SAS 146 is quality management standard that will be increasing the effectiveness for audits beginning after 6/30/25. So this is an additional guidance surrounding the quality control standards for engagement reviewers, specifically around the individual clients. SAS 147, this is actually another acronym, is NOCLAR. And we'll go into this in an additional slide as well, but just remembering that it's actually already effective as it became effective 6/30/23 for any audits performed on or after that date. 148 is the compliance auditing standards, and these are increasing through the adoption of the amendments, which addresses audit evidence, which is SAS 142, as well as the risk assessment standard that we'll go into a little more detail on, which is 145, but kind of the impacts and what that looks like for compliance audits performed. And lastly, 149, audits of group financial statements, including the work of component auditors. This standard is effective for audits of periods ending 12/15/26 or after, so we have some time on this one. And we're going to jump into polling question number 4.
Thank you. This is our final polling question for the webcast. Do you expect the new standards to enhance financial statements? A, yes. B, no. C, no changes are expected. For those of you that would like a copy of today's slides, you can download them from the folder that says slide deck and handouts. We will also be sending them out via email tomorrow, along with a recording of the webcast. Once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. And we'll give everybody just a few more seconds for those last couple of responses here. And the results.
That results a little bit of a mixed bag here. So nice to see, many of you aren't expecting a lot of change. Some are, about 45% are. And a few people aren't expecting any change, or not expecting it to enhance the financial statements. So we're going to jump right into a little more detail in these auditing and accounting, or auditing standards. And I'm going to try to focus too on really how this impacts your organization, because I know some of you may be thinking, this is an auditing standard, but it does have an impact on you, so to try to focus on that piece of it. With SAS 143, it clarifies the definition for many of our key estimate terms. So you can see here there's the list of accounting estimate, auditor's point estimate, and auditor's range, estimation uncertainty, management bias, management's point estimate, and outcomes of an accounting estimate. This standard is effective for calendar year ends 12/31/23, which will have an impact on how estimates are being audited. This standard increases documentation and evaluation process surrounding each estimate within the financial statement and those disclosure notes. This has likely been done in the past for significant estimates, such as looking at a bad debt allowance for the current year and comparing it to the allowance from the prior year, as well as write-offs that have occurred during the year, and maybe any recoveries as well. As Sasha has mentioned, the new standard with CECL, they're kind of going hand in hand too, to be able to look at that CECL and really the defining metrics and disclosures relating to how that policy is derived. Looking back is the best way to test and support reasonableness of management's assessment of estimates. Other key items play a role, though, such as current market conditions, changes in the economy, the specialists being used for evaluation, the processes and controls all at the same time. So in many cases, and describing of those policies all in place. Additionally, this standard requires evaluation of the disclosure note as to how the estimates are being developed. Knowing the standard is coming allows you as an organization to prepare. Taking a look at estimates, documenting a clear and concise fashion, which assumptions are being used, what the support is for those assumptions, and when evaluating those disclosure notes, really taking a look at the details and seeing if they're very clear and concise so that a user can easily understand how those estimates are developed. Next, we're going to go into SAS 145. This is probably one of the larger new auditing standards, which really redefines requirements and guidance surrounding how risk assessment is being performed. This will require your auditor to gain an understanding of the entity's system and internal controls and assess the control risk associated. This is inclusive of IT general controls as well, which is additionally testing, and why I've covered the user access and change management side more so in that internal control considerations portion, but really so imperative for organizations nowadays. The new requirement is to assess inherent risk and control risk, which means that in your audit, there are account balances that are inherently more risky, such as an estimate, since we keep talking about estimates. This balance may be higher risk because there is uncertainty about an estimate. Control risk may be lower or higher depending on the control cycle and those internal controls designed and implemented. These are considered separately now, and they're separately from inherent risk, as the account has already been determined to be high risk due to the nature of the account being an estimate. As you can see, this is going to change into a two-step approach and will change the way that auditors are assessing risk, as well as how they develop the audit plan to address the risk. This is a great deal of judgment still, and different auditors may identify different levels of risk based on historical knowledge and their understanding of the entity. Also, the evaluation of control risk from inherent risk will be performed over different risk areas impacting the audit. An example of this would be going concern or debt covenants. Increasing policy and procedures surrounding management's evaluation of key reporting cycles will become even more important. Lastly, I'm going to cover SAS 147 in a little bit more detail. And I use that acronym NOCLAR, which stands for Noncompliance with Laws and Regulations. So this is an increased regulatory standard that really looks at the ethics, and the standard is really to define the steps involved with when noncompliance is discovered within an audit or suspected within an audit. So auditors now are required to go through a step-by-step process, and there's a tool created by the AICPA to follow that really documents the plan, which is documenting the inquiry or how it was noticed, communication as to who needs to be communicated to, and evaluation of the matter at hand. We don't expect this to have a significant impact because we would hope that noncompliance with laws and regulations aren't super prevalent in many organizations, but now there really is this defining step-by-step process. And we wanted to save a little bit of time here for questions. And I know they've been coming in from the chat. So
thanks, Ashlee. I can take a few.
Oh, sure.
Oh, perfect. I thought maybe I hit a few. We have a few themes on a couple of the data collection from questions and then also on CECL. So I thought I might just hit a couple that we've gotten a few times here. One related to the data collection form update was, do we need to create new login accounts from Census to GSA? And yes, you do. Your logins that were previously under Census will not roll over to the new site, so you'll need to make sure and set up an account for that piece as well. As it pertains to some of the CECL things that we got inquiries on, we had the question come through a few times that's asking, is CECL really going to be replacing our allowance for doubtful accounts for all trade receivables? And, we want to be clear, it's not replacing your allowance. So we are referring to it in a different terminology, but you still have that same allowance that you'll book against the related receivables. What's really changing is the way you are estimating that allowance. So the allowance has always been an estimate. It will continue to be an estimate. Now really it's more the methodology of how you calculate that estimate that is being impacted or changing. And so that's the piece. And there was another question that came along those standards, like asking, if we've never had a loss on our receivables, we wouldn't expect any loss going forward. What do we do? And I think to follow up on that as well is you can, as long as you're going through the process of estimating what you believe the allowance would be, then you're going through the process and satisfying the standard. There is no requirement that you have to record an allowance. If you've gone through your process and your methodology and done the whole evaluation and estimating process and determined there's nothing that would indicate an allowance is necessary, then you still would not have an allowance. The standard is not requiring that you have to have a dollar value assigned to that. Those were a couple that we saw a few themes on over and over, so I just wanted to address those. But I know there's some other questions in the chat as well. We need to toss it back to Danielle for a few closeout comments, so we'll be sure and follow up on those questions that we didn't address after the webcast.
Thank you, Sasha, and thank you, Ashlee, for a great presentation today. To our audience, if you do have further questions or comments, please reach out to us as we would be happy to continue the conversation. You can drop a note in the Q&A window or reach out to Sasha and Ashlee directly. Their contact information is in your console. If you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks if you have difficulty downloading it now. Here are a few resources for your use before we go. And finally, here's a link to a survey for today's presentation. Your feedback is appreciated so we can make the most out of your time with us. Thank you again for joining us, and take care, everybody.